Timothy Riddell, Head of Research at ANZ. He joins us live from Singapore. Timothy, good morning and thank you for joining us. Last week everyone was celebrating, they were in good mood, there was a Santa Claus rally which was at play, but come 2014, markets are down and markets have fallen without any news.
Well, I wouldn't say they've fallen without any news. They've fallen as we're going into a new year when interest rates are going to be steadily moving to the upside. So seeing a bit of a pullback after an extraordinary 10 days of an upside run, to me is actually rather healthy. I was actually quite pleased to see the markets looking a little bit more rational yesterday. PMI data in Europe was not strong in some of the core countries. And so if you're saying there was no news, well, that really was something to focus on, that there was disappointment in the final PMIs, especially in France. So there were reasons for us to see a bit of a pullback after the festive euphoria that we saw during the previous 10 days.
Timothy, hi, morning. So which asset classes, according to you, would be in a sweet spot in 2014? Because we've not even had a good show by commodities.
Right. We've got to remember that we're going to have a very low inflationary environment through the next year. We're going to have rates in developed markets still tied to extremely low rates. Real rates are going to be very low, and nominal rates are going to be very low. In that environment, bond markets might suffer a bit as the focus moves away from huge quantitative easing to reduced quantitative easing. And equities, I would have thought, will still be underpinned. So any pullbacks in equities over the next few weeks, I would say, are an ideal buying opportunity. The equity market profile should remain relatively solid. But we're going to have a slightly diverse view towards the Asian region. So we're going to have a more even growth profile globally, which should help general trade, but the domestic growth environments within Asia are going to be a little bit different. So certain economies are going to outperform within the region. The Philippines looks like a great standout. So any pullback, say, in the Philippine stock market or in the developed market stocks, I would say are ideal opportunities to buy. Still a good year for equities.
Timothy, let me just remind our viewers that there are two factors which currently are not favoring the bulls. Number one, in 2013, US markets have gone up because of P expansion, not earning expansion. B, US bond yields are almost at 3%, which clearly is the line in the sand. So, at a time when interest rates are moving up and US earnings are not growing, what is the case for equities?
Right. It's an interesting profile you say there, that you think 3% on 10-year yields is a line in the sand. To me, there's scope for the US yields to continue to edge higher. It was only in April last year that we had US yields down at 1.6, 1.7%. So they did move a lot during last year, and I'd expect them to continue to edge up towards 3.5% during this year. So the bond performance is likely to be a difficult one. It's going to be a downturn for bonds next year. For equities, they've still got strong cash holdings in developed markets, especially in the US. And what we're waiting for now is some further clarity on the fiscal side to see whether we get an investment pickup. If we get a capex pickup, an investment pickup, and also on the consumer side we see a housing pickup, then I think there will be a lot of reasons, especially in the US, to see a positive cycle build. The same with Japan. If we watch to see whether we can get structural reforms and fiscal reforms to promote capital investment, then Japan can be a positive factor, not just for its domestic market, but for its global supply chain pool. So I think there are positive reasons out there that if, and it's a big if, the last 4 years we've been looking for a positive profile from developed markets and they've faltered. If we get the capital investment, the cycle start to build, then it could be a very positive year for the developed markets against how they've performed over the last 3 years.
Right. Timothy, the other bullish argument, and since we are independent market commentators, we don't take sides. Let me switch side. The bullish argument is, in last 10 years, no one has invested into equities. All the global money has moved into fixed income. It has only moved into commodities. Do you think 2014 could be that year of switch?
The switch into commodities returning, do you mean? Or do you mean that
switch out of bonds,
it's a further move into equities?
No, switch out of bonds and fixed income products into equities. Because even though US markets are at a record high, there are no traces of euphoria, bubble or massive inflows.
Right. Well, we've been seeing a constant flow out of funds which invest into bonds and into emerging markets, and a flow into developed market equities. At ANZ, we refer to it in a slightly clumsy manner as reversification. And it's picking up exactly on the point that you're talking about. Over the past 10 years, we had a diversification away from developed markets, and especially away from equity markets, into emerging markets, both in equities and bonds, and also into bond markets globally. So what we're seeing now is a shift of those flows. We've seen some going into US equities, but there's still a potential huge amount to go into developed market equities. If we think about the flow of money that occurred with quantitative easing, there was about $2.2 trillion went from the US into other markets, and about 1.2 trillion of that went into Asian markets. If we see some further withdrawal of that or return of that money into the US markets and developed markets, it's likely to go into the equity side rather than the bond side, because, as I was saying, we're looking for US yields to continue to rise. So I still think that flow is there. That potential is still there.
Timothy, what's the sense that you're getting about Indian equities, especially in the light of the economic as well as political landscape that we're currently in? More importantly, with the moves in the greenback, the rupee as well is going to be impacted, and that in turn will affect equity moves too.
Yeah, well, first off, we've gone through the worst point for India. The actions that the central bank have taken over the last few months have been pretty supported by the global markets. But it doesn't mean that the scenario for India becomes particularly positive. What I'm picking up from the international investment community is that they're really hoping that a Modi victory in the May elections will give a further boost to the potential of infrastructure and structural changes within the Indian economy. So there's definitely a demand from international investors to get involved in India. My fear is that we're not going to get the dynamism that they're looking for in terms of infrastructure investment and structural changes. So I have a rather mixed view on the Indian economy. The low growth profile that we've had over the last year is likely to continue this following year. So even if we get an uptick in our current low growth forecast, we're only looking for 4.5% growth. Even if that goes back towards more consensus of around about 5%, that's still below trend for India. So growth might not be as bad as it was last year, but it's not going to be great. And inflation is really sticky. So I see a problematic rather than a positive profile for India, but the worst has probably been through. As for the dollar and the rupee, if we get dips back down below 60, I would have thought it's a buying opportunity for dollar investors to buy dollar rupee. I don't see a lot of strength in the rupee coming through next year.